all bases of comparison that most people are talking about, 30s and as a fair level, and even 15s, they're only coming out the ground at 6.9 now. If it's silver ounces to gold ounces, which is already a single digit, so that's not extreme. That ties in with what, and you could overshoot to that. You could have three silver ounces buys you a gold ounce at some point. I'm not saying that as a prediction, but in an exceptional, for a day, a moment, in an overshoot, nobody said you'd get 128, virtually 129 ounces of silver needed to secure a single gold ounce, because the original movers were the central banks, and they were moving the needle on gold, but trying to keep a lid on silver, because that's part of a suppression technique on a smaller market. So you have a complete perversion in one direction, and you will get an overreaction when it is unwound to the downside, and you will have unobtainium.
The silver price is broadly firm due to a weak U.S. dollar amid uncertainty surrounding the U.S. trade policy outlook. Investors worry that some countries could demand revisions to trade deals with the U.S. following the Supreme Court's verdict against President Donald Trump's tariff policy. One of the most significant signals in the entire metals complex right now is what the gold-to-silver ratio is doing. At current prices, the ratio stands at 59.34. A 15-year low, last seen in 2011. In April 2025, the same ratio peaked near 120. Since then, silver has dramatically and structurally outperformed gold, compressing the ratio by more than half. Analysts forecast silver reaching $180 to $400 per ounce in 2026, with the gold-to-silver ratio at a 15-year low near 59. Veteran financial analyst francishunt emphasizes that the current gold and silver rally validates the long-standing sound money thesis he has discussed since 2009, when forecasts of $5,000 gold seemed unrealistic. In his view, market extremes often reverse sharply, and silver could significantly outperform during an unwind. Based on fundamentals, Hunt also mentions unusually high COMEX delivery interest relative to available metal, suggesting it could expose stress in the system. The COMEX registered silver inventory reached a critical tipping point in late February 2026, dropping to approximately 88 million ounces. This is the lowest level in years and falls below the major psychological threshold of 100 million ounces, signaling an acute physical shortage as the March 2026 delivery month begins. If you're ready for unfiltered truth and sharp market analysis, hit that subscribe button. Let's explore the latest insights from francishunt's recent interview.
The incredible thing is my life feels synchronized with the whole Ponzi-onomics and the sound money theme. And, our very first videos were talking and covering gold in 2009 when Bullion Vault was launched. They were actually just a bit before that. I monologued and read out their core report for the case of sound money. I remember him saying 3,000 and minimum, then 5,000 and beyond, and you had all these assumptions and everything pulled to stain. And I was reading it out and all of that. And back then, we traded as low as 1,060 odd, just before 2016 lows, which was the Shanghai Accord. And now all those numbers that he's spoken about are already well done, and we haven't really begun all the major resetting that we truly need to do. The gold-silver ratio, generally, we feel you will get an overshoot. Don't forget, you went as high as on this moment here, which was during the 2019 events. You went as high, according to Oanda, 128.692. Just think of those 25. So let's go with 25 coins a tube. You're talking 4 tubes plus another tube, and then still another 3 individual silver ounces just to get that one tiny gold ounce. That has been it. And they get pulled out the ground at single digit numbers. Whatever overshoots to the upside has a habit of chronic overshooting to the downside, and all bases of comparison that most people are talking about, 30s and as a fair level, and even 15s, they're only coming out the ground at 6.9 now. If it's silver ounces to gold ounces, which is already a single digit, so that's not extreme. That ties in with what, and you could overshoot to that. You could have 3 You know, 3 silver ounces buys you a gold ounce at some point. I'm not saying that as a prediction, but in an exceptional, for a day, a moment, in an overshoot, nobody said you'd get 128, virtually 129 ounces of silver needed to secure a single gold ounce, because the original movers were the central banks, and they were moving the needle on gold, but trying to keep a lid on silver, because that's part of a suppression technique on a smaller market. So you have a complete perversion in one direction, and you will get an overreaction when it is unwound to the downside, and you will have unobtainium. And we've already had patches of that. And a lot of people are pointing to the COMEX delivery and saying there's a lot marked for open interest delivery for which the stocks aren't already there. So you could have a contagion event sooner than you think when you ask, when will we have a kind of a Lehman-y moment where the things that's going bad suddenly have a whoa, and it gets into Main Street and everybody realizes and starts making the front pages? Well, that might be coming shortly, you know, in February into March. It could be, but it might not. I can't tell you when news media will start to run what they should be running. But the scam is big. The scam is debasement. It is the debasement of both fiat and debt. And there's very few places that does the real job of capital preservation. And it's not the time to be 5%. Do you insure 5% of your car? Do you insure 5% of your house? Well, it doesn't mean you should insure 100%, but in some ways, I've kind of insured 200, 250% by activities, but I still don't have 100% only assets in gold if I talk about what I physically own. But I've used other instruments to be overweight, over benefiting, and then it's made us and our community members extensively wealthier. You're in the early doors stage. So to many people, this has gone on too far. Everybody frames things by their own personal frame of reference. This is the bull market to end all bull markets that ends, in essence, a fiat and debt debasement that has been going on since the establishment of the Federal Reserve, the original gold heist that saw the confiscation and then the revaluation up, the Vietnam War that led into the debasement of, they dropped more munitions than they did in the World War II, the Americans. And so the French started calling for the gold. That saw the window be closed. They were cheating. They were fraudulent. So you really want to believe known cheats and frauds, that everything in Fort Knox is in there? You're starting to hear some rumors and funny stories. I can't verify them, whether they're true or not. But if you're asking me, are they cheats and frauds? I would say yes. So do I have the confidence that everything is exactly as it should be in terms of Fort Knox? When they lie on the non-farm numbers, they do umpteen revisions, monthly, quarterly, everything. It's all about the initial number that everybody reacts to, and everybody forgets to react to the big revision back down later, because new number, you know, all of those things. They're lying on the CPI. The dollar lost. I mean, why do we say relying on the CPI? Apart from shadow stats, which quite clearly runs the Ronald Reagan era numbers of 1983, I think it is. You look at the fact that the dollar lost 12.5% to the euro. This is a leper colony. Currencies are a leper colony, but some lepers are even more flaky than other lepers.
francishunt argues that the silver bull market is still in its early stages. After the sharp move toward $90, he maintains his long-term upside target toward $333, then potentially much higher as the gold-silver ratio compresses into single digits. In his view, past ratio norms like 30-1 are distorted by decades of monetary manipulation, while actual mine supply is now closer to single-digit production ratios. He suggests that when the ratio unwinds, it could overshoot dramatically in silver's favor. Moving forward, Hunt frames the move within a broader monetary reset. He contends that the everything bubble is already deflating when measured against gold, pointing to the Nasdaq to gold ratio breaking down technically. The real story is that fiat currencies and debt are losing value. When investors start losing confidence in bonds and expensive stocks, money usually moves into gold first as a safe haven. After gold rises, silver and mining stocks often follow. In his view, this isn't a normal stock market boom. It's investors trying to protect their wealth from currency debasement and financial instability. Let's jump into the interview.
If we talk about the silver market, and I mentioned that we were fortunate enough to get out, Many people might be in disbelief. Go and have a look at our X there. That is the value of real technical analysis on a volatility-based function. But we knew after the run of the $90, and I believe I would have shown you this long-term silver chart possibly the first time I showed up with you, Stick, but I want to show it to you again if I didn't, to remind people. I've just got to do a small adjustment over here, 49.81428, and take that out as an imperfection. So this is our targets to remind everybody. So how far are we to where we expect to go? So first of all, dollar targets, we've said 333, then you'll have another rest. 333, you'll have another rest. And then eventually you will go single digit gold silver ratio. Many people are shocked at that. They say, well, for the last, it was normally 30 or whatever the case may be. You've forgotten the whole cycle goes right back to, beyond 1913. Everything you're comparing is part of the perversion where there was substitution against precious metals and the financialization of everything that led to the everything bubble. And right now, that bubble is already bursting. Everybody goes, when reset, Francis, as if it's like one day, one time, one moment. It's a process, and that process has already gone. We've shown the NASDAQ divided by gold ounces, massive head and shoulders. The stock market is re-rating against the gold ounces. Everything is re-rating against gold ounces. But just to finish with the silver, as I brought you here, this was the run of the 90.5. We said, okay, you're going to have an overshoot and you're going to have a pullback here. So we became slightly less aggressive on the leverage trading. We were looking for reasons to get square on leverage. All our profits we take out, which are what we call in our red pot, which is the top of the pyramid, the middle slice, the orange pot, which is light leverage, and then tax it down to the blue pot so it becomes in new investment proceeds. We've been buying during the lows. I say lows, it traded to 64. The cheapest I was able to buy 7-digit sums of silver for was 94.8. That was when it was around 77. So the difference, and there's very many places that simply couldn't fill big orders and weren't interested, by the way. So this whole notion of, oh, there's no bullion dealer that wants to buy my stuff back. My local here in South Africa said his buybacks, which he used to do a lot of, and take that stock back in, have gone down 80%, and he's sold out all his next delivery before it's even arrived. So forget those social media posting that are trying to give you the notion that there's no demand for it in the dealer network for selling back your silver. So this goes to 333. This is log scale, by the way, just in case people think that's not a brave shout. That's the distance in normal arithmetic geometric scale. So that's how much more you've got to have to go. And once you've run and reacted to the second interim, which is here, the open territory in between the core targets, the second interim and the full target, typically is covered. It's open territory, the horse running across the field, galloping across the field. It's when it comes to the fences that it has to run and jump and then has fatigue and exhaustion and relaxes for a bit because that was tense. So it's like a fence. Think of it as fencing level. So this is a real massive part. The main part of the move is still to be coming on this. And then we go 4 digits on the single digit gold silver ratio call. So that's how early you are. You could have got it all wrong till now. And if you just play well from here, and you don't even have to play a blinder, because the best part, the most single-minded part of the move, which is going to freak everybody out and is going to have everybody every day going on X, can you believe it? New high silver, this much, silver's a bubble. You're going to hear all of that. That's all still to come. That's all to come. And it's not the metals that is the bubble. You're in an escalating fiat and debt devaluation. Every asset, everything asset is devaluing in gold ounces, which should be your unit of account now. No fiat is good enough. They are all lepers in a leper colony. They're all sick and dying. The rate that they're dying is a moot point, but the dollar hegemon is the most vulnerable one. And it's not the cleanest, dirty shirt in the laundry. It's the largest, filthiest shirt. It's in the Triffin's dilemma design. They give paper to China and Euroland, the big economic blocks that they have their largest deficits with. In the opposite direction, dollars and T-bills go. Only now the appetite, since the call we made in 2020, about the debt market turning being our most significant call, and that the debt market crash is the turbo juice for the gold, because it is substitution of preservational asset. You had a masquerading asset, which was a bond asset, which was being in an ever abused, proliferated market, was going to hit the skids at some point, and we called it on 2020, the late part of that year, after the proliferations under COVID-19. That is the whole story joined up into gold. It's amazing. And then we saw Druckenmiller and Tudor Jones say they suddenly very short debt in 2024. They were the next major name. Then I saw, the likes of, I'm trying to think of other more accepted commentators in the market space suddenly saying, I wonder if debt is going to drive, the downfall in debt is going to drive the run into gold. So that's the IXIC. What I want to show you, that's NASDAQ, is if you divide that by gold, that everything is the everything bubble is rebasing. You are already in the reset, and the only place you should be standing is where we keep saying. And here's your head and shoulders. If I switch the light back on and you see it, that is it. You're actually in the month that the head and shoulders for the NASDAQ divided by gold is breaking down. I've been here for all the key moments, and many people don't know these are key moments. You are in the month that a nasty attempt to regain. So you broke down, you did a test break, you got bought back up, you ran on up. Yay, we're going back up. Tech is the dominant thing. Go, AI. No, it's not. Smash it back down, smash it through the neckline. And as you can see, we're forecasting for that to run all the way down substantially. We've got targets right down here. And we've been watching the setup while David Hunter and other people were saying, wait for the moon off and the blow off in shares. This is not a share trading environment. This is a capital preservation era where gold is the ultimate domination. The only thing you should care about is being in the winner. Why be raving about number 3 and number 4 in the deflation debasement stakes when you can have the only one that's not debasing at all, that is actually going up in relative valuation across nearly all assets. The only one that gold will not outperform is silver and platinum, and probably a selection of miners at certain stages. But after you've had a slap in the face like we just had, the first to recover is the king, the anti-fiat, which is the real money, the original money, who keeps showing up, the fraud money, which is the king of fiat, dollar, but all the other fiats as well that are part and parcel of this. You are watching rebasement of the NASDAQ. There was a time when the NASDAQ was better, and they were winning on their financialization of everything, Chloe, and you should have been 100% long tech stocks during this era.
Given the current momentum, gold and silver prices have room to move higher this year. Silver is positioned for a strong, though highly volatile, performance in 2026, with many analysts expecting it to outperform gold due to a deepening structural supply deficit and explosive industrial demand. If physical supply tightens further and confidence in fiat currencies keeps weakening, could silver's outperformance accelerate far beyond expectations, and are investors truly positioned for that shift? Let us know what you think in the comments. If this video brought you any knowledge, give it a like, subscribe, and ring that bell so you're always in the loop. See you in the next video.